Are you tired of your fair value gaps constantly failing you? Well, if you are, I am here to help. All jokes aside, though, man, what's popping? So, welcome to another video. Today, I'm going to be talking to you guys about the 7 things that I look for when I'm looking at my fair value gaps and how I trade off them and how I determine my entries on which ones to avoid and which ones to take. So, I think this 7 list is very key, and it can definitely help you avoid a lot of losses and just filter out the good versus the bad. This list is in no order. This is what came to my head. What came to my head first. So yeah, starting out with the first thing that I have right here is the time that it was formed at. This is very important because price moves off of time cycles. If you don't know, do your homework on it, do your research. It is important. It is a real thing. Pay attention to the time that it was formed at. Was it formed pre-market? Was it formed at market open? Was it formed at the start of the macro? Was it formed during London session? All this stuff matters, and all of this stuff is key when trading fair value gaps. The time that it was formed. Number two, the speed in which it was created. Now, the speed is very important because if an imbalance takes a long time to form, if we're not, swift and efficient, just with candlesticks in general, that's usually an indication of less volume in the market. That's an indication that price is likely not going to be as efficient just because we're not moving with speed and swiftness. That is a very key thing and very important when trading the markets in general, speed of candles. Number three, is it in favor of your draw and liquidity? Wherever you think the market is going to go, is this fair value gap supporting your bias? Is it supporting your idea, adding conviction to you? Number four, did we hunt liquidity without tapping it previously? Now, this is a very important one that I think is overlooked, and I think is one of the most important things, important ways on how to avoid losses when it comes to trading fair value gaps. Because perfect example is right here that happened today. We had this bearish imbalance put in that I fell victim to. I took this loss. Um, I entered early. I did not follow all of my rules, all of my checks on this list, which is also part of the reason why I'm making this video, just to help shed some light on it. So you see here, we made this 5 minute imbalance off of market open. We had relative equal lows resting beneath us. Now, where I went wrong at was that I just wasn't as selective when it came to this imbalance. We had swept internal buy or internal sell side prior to tapping it. We didn't use this fair value gap to actually tap anything. We use this would be known as a breakaway gap. When prices rushes to sweep liquidity without actually tapping the fair value gap, that's what's considered as a breakaway gap. We inversed this bearish 5 minute, kind of forming a small BPR, never tapping the imbalance before sweeping liquidity. So once price actually retraced to it, I ended up zooming in to the 15-second, which I will, talk about more a little bit later as well. But I zoomed into the 15-second, waited for price to tap it. Since we did leave relative equal lows, I still wanted to see it get swept, which is, where I went wrong at. I was trading off of my phone. I didn't have a full concept of where price was at the time, which is I'm the only person to blame for that. So I'm still looking for shorts at this time, not really realizing what price actually wants. So once we got this, small, this isn't even a full change in the state. Honestly, this is not the best setup. This isn't the best trade at all. Change in the state of the 5 minute, I wouldn't even identify it as a real change in the state, honestly, but we got it at the 5 minute. I took that short, ended up losing, got instantly stopped out. And that is where I made my mistake at, and that is something that you can avoid. If we sweep liquidity, prior to tapping an imbalance, if we sweep opposing liquidity prior to tapping that imbalance, I would say wait for, like, if you're going to take another trade off it in that direction, because these are usually the make or break type of fair value gaps that I would consider. Because if we hold them, if we swept this, let me zoom out right quick. Where we at? I'm on the 15-second. I'm tripping. My fault. But if we were to hold this imbalance right here after sweeping these internal sell side levels, price would have, 99% of the time completely sold off. Because these are the type of fair value gaps that usually hold the most weight. A fair value gap that comes, right before buy or sell side is swept, those are usually the strongest trampolines, in a way, just kind of as a metaphor. Metaphorically, these are the type of trampolines that will push price the highest or lowest when it comes from sweeping opposing liquidity without tapping it prior. So when we first tap into when we definitely want to be more cautious. You want to be more just attentive and selective when it comes to these imbalances, because they are likely to either fail or they will hold and give you a very strong rally. Now, if they were to, like, I would say when in situations like this, they are more likely to fail just because we already did sweep liquidity. And 9 times out of 10, once you do sweep any type of liquidity, price will get that reversal, especially if, we did tap a higher time frame imbalance, which I failed to identify this morning. We tapped the 15-minute. We had this 1 minute reaction off of it, 1 minute change in the state, which is honestly an A+ buy model that I just didn't recognize at the time, which is completely my fault. So yeah, pay attention to whether or not we took buy or sell side, if we didn't tap it already. Pay attention to the resting liquidity surrounding it. That is very important and can increase or decrease the likelihood of the imbalance holding, if I describe that properly. I think I did. I just kind of yapped a little bit, but that's that. Number 5, what I would say is another way that I am able to it kind of goes hand in hand with number 4, but just determining and filtering out wins and losses is waiting for reactions out of imbalances and not just blindly longing or shorting them. An example would be perfect right here, honestly. If I just waited today, let's go to 30-second. Looking at the 30-second, if I would have just waited for my actual model, which never even truly presented itself, this would have been an avoidable loss. We never truly got a change in the state out of the 5-minute. We never actually showed any reaction to us wanting to sell off from this 5-minute imbalance. And this was an avoidable loss because of that. I should have paid attention to the 30-second. Completely my fault. But waiting for reactions out of imbalances can just give you extra confirmation without just blindly longing them. Like for me personally, when I just, blindly long an imbalance without waiting for a reaction, my win rate is a lot lower. I tend to lose a lot more trades because I don't wait for a reaction. Perfect example, I'll just draw out right quick. Let's just say we have this imbalance here. Let me just draw a quick one. Say boom, we tap it. I enter short, wanting to see, whatever sell side is, whatever is here. I want to see us tap here. If I were to just blindly short this a good amount of the time, price, I don't know if it's my luck or what, but a lot of times price does run these imbalances. So what I have, began to do is zoom in now. I'll say forget this entry. I will then zoom in. I will wait for, price to have an internal change in the state. I will then short either off of the change in the state or a tap back, and then that will be my short, because this also poses a way better risk to reward as well. Now, if this is my entry right here, stop is now at this high, targeting, the external draw and liquidity. My risk to reward goes from a 2-to-1 to a 5-to-1. All just by waiting for a simple reaction, which can be a change in the state, an inversion fair value gap. You can look for a 2022 model, whatever you want to look for, forever model. There's a bunch of models you can look for inside of fair value gaps because price is fractal. Whether you're trading off of the hourly, you will look to take a trade off of the 5-minute. Like if it's an hourly fair value gap, you want to look to trade off the 5-minute. You want a 5-minute change in the state, some type of 5-minute reaction, a 5-minute inversion, whatever the case may be. That's what you're going to look for. If you're off the 4-hour, it's going to be the 15-minute. If you're trading off of the 15-minute, it'll usually be the 5 or the 3-minute. If you're trading off the 5-minute, it'll be the 15-second, and so on. If you're trading off the 1-minute, I really wouldn't recommend using that as a fractal entry, just because the 5-second usually poses a lot of iffy price action. I wouldn't really recommend anyone touching the 5-second unless if it's like, it really depends, but I don't think anybody, especially starting out, needs to touch the 5-second. So really, I wouldn't recommend going anywhere beneath the 15-second. The 30-second is usually the best spot for me, at least the 15 to 30-second when I'm trading off of the 5-minute and so on. But yeah, just waiting for a reaction out of imbalances is a very important and a very key way to determine whether or not it's actually going to hold or not, because you can easily just blindly long it and price will just continue to run it. Price will continue to run it. We never got no true reaction. Price never actually showed us that we wanted to hold it. So just waiting for reactions is another very important and very, key filter that I use to determine whether or not a fair value gap is going to be valid or not. Another thing, size. Size definitely matters when it comes to these. Size is very important because if you're trading off of if the fair value gap is not you know, if I can't walk to the back of this room and still see it, if I can't make this chart super small and still identify the fair value gap, 9 times out of 10, it's not that valid. It's not that important. Now, that doesn't mean that it won't hold, but it's not as prominent if, you know, the size of the fair value gap is like this. It can still hold, but it's way less likely. Size, you know, if it's a on average, I like to see an imbalance. Typically, like this, honestly, this 5 minute is a very good example of a pretty good looking fair value gap. Just 11 points wide, like something like that. Typically, if you can walk away from the screen, step back pretty far, and still recognize the imbalance, and that is usually a good one. Another thing, location. This kind of goes hand in hand on number 4. 7 and 4 are kind of similar because location is very important when it comes to it. If we have already swept any type of, you know, liquidity in the opposing direction of it, or if we have a fair value gap closing through it, if we formed a BPR, that means it is way more likely to hold as well. BPR would be, an example of a BPR right quick that is respected. This is a BPR. If we close through a fair value gap and make another one, this in turn is a BPR, which gives price a much more likely opportunity to respect it. As you can see here, we ended up respecting it perfectly for very good risk to reward if you would have just entered off of here. Now, let's say we waited for let's say we looked for the reaction. You see, we would have just blindly entered. That's a 3R. And let's see right here if we would have taken it off of the reaction. What is it? Big high. I just want to show y'all how I usually like to do it. Look at the 30-second. Now this would have been my entry probably. Stop at this candle low because we did just close back above the inversion for value gap. So this would have been my stop loss. If I were to take this trade risk to reward, let's see what it would have been. Okay, relatively similar, actually a little bit worse. So it really is subjective. It does depend, but this has a much higher win rate when waiting for a reaction. You know, you're not going to have the same risk to reward every trade, but when you are trading like this, waiting for reactions out of the imbalances, your win rate definitely does skyrocket. You avoid a lot of, you know, unnecessary losses when you do that. But yeah, those are my 5 or 7 tips. I mean, just 7 filters, 7 tips on how to identify, recognize properly whether or not a fair value gap will be valid or not, whether it is important to pay attention to, and all that. I think the most important thing is just paying attention to whether or not we already swept buy or sell side. Pay attention to that. Pay attention to the size, time, speed, just everything here. Pay attention to that. Write it down. You know, pay attention to the fractal price. I'll write it out right here for y'all. 4 hour, 15 min, 1 hour, 5 min, 15 min, 15, 1, 5, 30/15 second. I would say keep it at that. And it goes so on and so. The daily, you would go to the 1 hour or 4 hour, you know, weekly 4 hour, and just do it like that. Price is fractal, so when you're looking for these reactions and all that, definitely pay attention to that. Take a screenshot if need be. But that is it. Those are the just the confluences that I use and how I look to filter and identify these fair value gaps. So yeah, I hope y'all enjoyed. I hope y'all learned something. I will catch y'all in the next one. Thank you for watching. Please like, comment, and subscribe. Peace out.